Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And that's what I love about options, because you can decide you want to have a limited risk by buying, let's say, a call or a put. And long options are best deployed when you think that the market's going to have a big move. Now, many are probably saying, well, of course, I think the market's going to have a big move. But you got to remember that the market also understands or expects certain things. And right now, everyone's expecting a big move. So that just means that prices are a bit higher now. So you have to sort of look in context of what the options market is looking at. So due to the options limited cost, an investor holds all the upside for calls or substantial downside for puts with limited amount of risk. So when the market expects a big move, well, then the premiums are going to expand, and that's sort of the market we're in today. And when the market doesn't expect a big move, well, then it would be the opposite. Sorry about that. My computer, for whatever reason, is giving me a little bit of a problem here, so I apologize. Sorry about that. Can everybody still hear me? And you can still see the slides, I hope?
Yeah, you're good on my end, Steve.
All right. Sorry about that. My computer's doing some strange things here.
That's the joys of working live with technology.
Yeah, it's, let's see, hopefully I can, yep, great. So option premiums, there can be used to gauge investor expectations. Really important to understand that. And that is a very important concept. Let me just try to do something to improve the situation here. Sorry about that. Okay. All right. A little power problem here, but okay, it should be good. All right. So the option premiums are basically telling us what's going on in the market, and are we expecting big moves or small moves. High premiums mean that people are expecting a big move, but we need to think about it in what context. Okay, big move means we're going to pay a big premium. Volatility is a conditionally biased predictor of the future. It's also called realized volatility. And we've seen ridiculously high realized volatility recently in the FX options. So options prices depend on what's called the implied volatility. More to that in a second. Implied volatility can help investors assess what the market's view the future is. So FX uncertainty, you get three sources of FX options uncertainty. You get the exchange rate itself. Jason will be talking about that. The interest rate differential between the two different countries, and the volatility of the pair. So I really concentrate on the volatility and the exchange rate. Not to say that the interest rate differential isn't important. It is. But I like to look at the prices themselves and the volatility. The interest rate differential is important, but let's just stick to those other 2 points. Pricing inputs, we have the underlying price, strike price, time left until expiration, the interest rate differential, as I said, and volatility. So Jason's going to talk about this. In fact, just try to remember this slide 18. In fact, you see that Jason, who really understands not only technical analysis, but the options market, he actually creates these support and resistance areas each and every week. And if you look at it, what he's giving you is sort of the curve turned to the side. And he'll talk more about that later. Remember that options traders believe that it's just as likely for the asset to be moving up or down in any one day, week, month, or year. We may not believe that as spot traders or if someone has a view, but the options market does believe that. So you can sort of turn that curve to the side that says that the options, that the U.S. dollar is just as likely to move down as move up. And what's interesting is we've seen tremendous trends in the last year that sort of would defy that exact curve. So it depends on what you believe. More about models, option pricing models try to calculate the probability of an event occurring. Most times the models are accurate. Occasionally they are inaccurate. Just remember, the models are going to be right about 99% of the time. They don't claim to be right 100% of the time. So the underlying exchange rate is the relationship between the strike price and the underlying price. And that Jason's going to talk about, how he looks at the pairs. So at expiration, all options are worth intrinsic value is 0. And one of the most important Greeks, I'll get to all the Greeks in a second, the option pricing expectation is measured by delta, the amount that your option is going to move based on 1 unit change in your underlier. So the greater the likelihood of an option expiring in the money, the greater the delta. And the strike price, you could select different strike prices. As I said, these options are cash settled, and the strike prices are 50-cent strike prices. So you can buy calls if you're bullish on the U.S. dollar. You can buy puts if you're bearish. And calls are going to give you, again, the ability to control the U.S. dollar. Puts will be able to give you the ability to sell the U.S. dollar. And that's really an important concept, that you can hedge your risk if you'd like to or implement a forecast. When you're trading options, time is money. So the longer you move out in time, in most cases, the higher the premiums. Time decay isn't linear, though. So when you're buying an option, if you're buying one that's very short term, the problem there is that you're getting a lot of time decay and what's called theta. Generally, the greater the time decay, though, the more the gamma. So the greater the potential that my option could be worth, let's say, very little and become worth a lot more. That's one good part, is that you get gamma. The bad part is that you're paying this time premium per day. And gamma manufactures delta, creating the option price change. The options have value for basically 2 reasons: the cost of money and volatility. And again, interest rates also. So it's the cost of carrying, so that is your interest rate, and your volatility. So if both rates were 0 and options, if you didn't believe the exchange rate would move, well, all options would trade at their intrinsic value or 0. We know that's not the case, though. Risk-free rates, ISE-FX options are dollar-based. So the U.S. dollar is the base currency. Due to the ISE-FX options being that dollar-based, U.S. rates are going to rise, puts will increase in value. As rates drop, calls increase in value. That's at least theoretically. So the rates are important, and you want to also look at the foreign rate. If you're using a plain old options calculator that you'd use for an equity options, the dividend yield would be the U.S. rate, and the risk-free rate would be the contra rate. So it's not that difficult to do this. You just plug this in. Volatility, how much is expected, and we're going to talk more about volatility in a second. It's just a variance, and volatility has gone from, let's say, depending on the currency pair. The most volatile one, and Jason's going to show you this, has been the Australian dollar, followed probably by, I think the yen is the next most, but the Canadian dollar is actually picking up now. So the price movements, we can look at 68% deviations or 95%, but we never, ever, ever get to 100% confidence level, and risk-reward remain in balance. So we have the Greeks. Last point before I get to allow Jason's going to jump aboard and start to talk about the technicals. And because the technicals are what's going to really drive, for most of you, it's going to drive your option strategy. Because it's nice to know about the Greeks, but more than likely you're going to have a view. What's going on with the U.S. dollar? Is it going to be moving up or down? How can I use options to help me with my view? So Jason will be here in just one or two more moments. And let me just get through the Greeks. Delta is going to tell me how much my option moves with the 1 unit change in the underlier. Gamma is going to tell me how much my delta is changing. So I can start out with a delta of, let's say, 50 or 52 in my example here. And if the gamma, based on an option pricing model, was 7.07, well, then if the pair moves up a whole point, well, the new delta is going to be about 59.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.